Fed has finally paused these rate hikes, these federal fund rate hikes. They finally said we're not raising or increasing the federal funds rate this time around. Now, guys, I just want to give you some insights to this very important news that broke and how this can and probably will affect each and every one of us. On this quick video, I'm going to give you why I think the Fed decided to pause the rate hikes and kind of what they may have been thinking with regard to 4 different areas when they decided to go ahead and not raise interest rates this time. Now, as you guys know, the FOMC, or Federal Open Market Committee, they were locked in a room for 2 days, and the Federal Reserve's chair, Jerome Powell, came out and gave his speech or gave his talk to the media. And ultimately what he said is that they're not touching the interest rates, the federal funds rate, right now. After all of their analysis and all their digging into all the information, all the numbers and all the trends and all of that stuff, guys, they made a decision to go ahead and keep rates right where they are for now. And they indicated that this is a pause right now. It's not a complete stop. It's not a step backwards. It's just them saying, let's hold up and let's wait on more data before we actually increase the rates again. And the Fed chair, Jerome Powell, he actually came out and said, that we could expect maybe 2 more rate hikes throughout the rest of this year in 2023. But that remains to be seen based on all the information and data that they pull over the next few weeks. Now, guys, this is the first time in over a year, about 15 months, that the Federal Reserve did not increase the federal funds rate. There was 10 straight rate hikes previous to today. And keep in mind, guys, the federal funds rate is just the interest rate that commercial banks charge one another for overnight lending. And when that rate goes up, it has an effect on short-term rates for all of us, right? Individuals and businesses who are looking to borrow money, all of that borrowed money now increases. It costs more to borrow money when those federal funds rates go up. And for now, that federal funds rate is still stuck at the 5% to 5.25%. Now beware though, because in July and maybe some subsequent months this year, that rate could go up. The first thing is this, guys. The inflation numbers came out just a couple of days ago. And the inflation numbers show that the CPI inflation rate was down to 4%. Excellent, very good. It means that inflation is continuing to go down. Now that CPI number of 4% is the lowest CPI reading since March of 2021. So over 2 years, guys, has the inflation rate, the rate at which prices are rising, has it been so low at 4%. Now, the core PCE numbers is just the overall inflation numbers minus energy and minus food, because the Fed says that energy and food are a little more volatile. So we remove those from the core PCE inflation numbers. And the Fed really looks at more closely the core PCE over the CPI. And the Fed does that because they say that the core PCE is a broader indication of what the overall inflation numbers look like. Now, that core PCE was actually up to 5.3%. And it's been hovering around that 5% to 4.5% range for quite a while. It's kind of stuck. The core PCE is really, really stubborn, and it's been what they call sticky, right? It hasn't gone anywhere. But the CPI numbers are down to 4%, but the core PCE numbers are not quite where the Fed wants to see them. Right now, the core PCE inflation numbers are more than double the 2% inflation rate that the Fed really wants to see us down to. So inflation is still there, right? We still have a 4% up to a 5.3% for the core PCE numbers in terms of the rate that prices are going up. So prices are still rising, guys. Not at the 8.5%, 9% they were last year at this time, but they're still going up. And that adds a little caution to what the Fed was thinking today. Now, the second thing I want to talk about real briefly is this, guys. You're probably saying, well, if the core PCE numbers are up to 5.3%, up slightly, why did the Fed decide not to increase the federal funds rate, to continue to fight inflation? Well, there's a few things that was mentioned in the press conference by the Fed chair, Jerome Powell, that I want to just kind of alert you guys to. The first one is smaller banks. What's happening with some of the regional banks? Now, we're not talking about the JP Morgan Chase and some of the large, the top 10, the mega banks that are out there. We're talking about some of the smaller banks. We know that just a few months ago, several banks collapsed, right? Because they just didn't have enough money in their reserves to cover their depositors requesting their money. But these smaller banks are still hurting due to the increase in the federal funds rate, right? They have all these reserves that they purchased when interest rates were really, really low. And now if borrowers all of a sudden say, we want our money, then they have to go sell off things in a higher interest rate environment. And that's a problem. And it remains a problem for a lot of small banks. And the Fed has taken note of this because a lot of smaller banks are really in a pretty fragile position right now in terms of having the assets to cover the potential of a lot of depositors wanting their money. So I think the Fed didn't want to put any more pressure on smaller banks right now. Want to kind of ease up off of them right now because a lot of smaller banks throughout America are in sort of a dicey situation, especially given the fact that the bank crisis a few months ago was squelched pretty quickly in the eye of the public, right? But for a lot of banks, those problems still exist. The problems that happened to Signature Bank of New York and the Silicon Valley Bank, those issues still exist. Now, the second reason I think the Fed decided to do a pause is because of what's going on in the commercial real estate industry. The loans that are being carried by many lenders is from those smaller banks that I just talked about. The commercial real estate industry is being hammered by these high interest rates. There's higher vacancy rates, guys. Keep in mind that a lot of folks are still working from home. And when folks are working from home and you have a lot of businesses that are trying to reduce their footprint, then there's no need for some of these commercial buildings. And so what happens is these commercial buildings see higher vacancy rates. That means less rents, less money for the owners, but who still have to turn around and pay a mortgage. So this whole work from home phenomenon is having an effect on the commercial real estate industry. And also the higher cost of borrowing money coupled with the higher vacancy rates means many of these owners of commercial real estate just aren't able to make and pay their mortgages. So that means ultimately more defaults on some of the commercial real estate loans. And I think I read a report, guys, that said they're expecting that maybe by the end of this year, there's going to be a 40% default rate for commercial real estate owners. And that's pretty high, guys. That's a crisis in and of itself, right? So the Fed understands that the pressure they put on by increasing these federal funds rate affects small banks, affects the commercial real estate industry, and also affects the residential real estate industry as well. We've got 30-year fixed rate mortgages right now hovering around the 7% mark, pretty high. And we see that home prices across the board are starting to take a hit, right? Starting to go down just a little bit. So all of these factors played, I think, into the Fed's decision not to increase rates and sort of take the pressure off, sort of be less aggressive than they had been. And in my mind, these are some of the reasons why the Fed did not raise the rates this time, again, for an 11th straight time. Now, another thing to keep in mind, guys, is the GDP. Now, the GDP in Q3 of last year was around 3.2%. That means the growth of the economy was around 3.2%. And then Q4 of last year, it was around 2.6%. And then Q1 of this year only saw a GDP increase of 1.1%. So the GDP is still increasing, but it's increasing at a much smaller rate than it had been just a few months back. And at some point, from 3.2% to 2.6% to 1.1%, at some point, we're going to be in a position where the GDP is not growing at all. And it's ultimately shrinking, right? That's when they're expecting some type of recession later this year. Now, the Fed has already said in their last meeting, and probably in this meeting, once we get the meeting minute notes, we'll see. But they said that they believe there's going to be a recession coming up in Q3, Q4, and perhaps into Q1 of next year. So we'll see. Now, the fourth thing that I want you guys to think about in terms of the Fed's decision to not increase the federal funds rate is to remember the labor market. Now, the Fed had been looking to the unemployment rate as one of their key factors to see what was going on in terms of inflation and making sure inflation was going down to their target 2% rate. But I really think the Fed has sort of changed and sort of shifted on that philosophy because the unemployment rate is still only 3.7%, which is still really low, right? It was down to 3.4% a couple of months ago, and that 3.4% was a 53 or 54-year low, and it's still only 3.7%. Now, they are predicting that the unemployment rate is going to go up over the next several months, maybe into the 4s, 4.5%, maybe close to 5% by the end of the year. That's what the Fed is thinking. But nevertheless, guys, I think they've shifted from that model of focusing so heavily on the unemployment rate as the main factor they were looking at. The Fed Chair Jerome Powell did come out and say that wage rates were not going up at the rate they were. still not rising at the rate that's consistent with a 2% inflation rate, but still wage rates were not ballooning out of proportion consistent with inflation at 6 and 7 and 8%. The wage rates were increasing, but increasing at a smaller amount as well. And he also mentioned that they still have a commitment towards maximum employment. And as I explained to you guys before in a previous video, when the Federal Reserve says they want maximum employment, it's not saying they want everyone to work. It's just saying that they want to get employment, maximum employment that's consistent with a 2% inflation rate. Because if everybody's working, then it would mean that everybody is spending money. And if everybody is spending money, then it means a higher rate of increasing prices, which is a higher rate of inflation. So the Fed really doesn't want everybody working, but they did make it a point to talk about and mention the fact that they still are looking towards maximum employment as something they're focused on. So let me just caution you guys on the fact that it's not over, right? It's not over. They're still predicting and thinking that we'll see some type of recession down the road. 30-year mortgages are up near the 7% mark. The average interest on credit cards are up over 20% at this point. So money is still expensive for individuals to borrow and for businesses to borrow. And expensive money is going to continue. Now, something else you guys want to consider and think about is the fact that in just a few weeks, the Supreme Court is going to rule on whether the student loan debt payoff, where everybody is getting $10,000 to $20,000 lopped off their student loans, that remains to be seen what happens with that. And if it doesn't go through, what is that going to mean in terms of people's purchasing power? And the fact that all of the forbearances are going to be up and everybody's going to have to return to actually making their payments on their student loans. That's going to affect a lot of households, perhaps up to 40 million households who have student loan debt. So how are they going to actually respond to that? To having to spend an extra $300 or $400 or $500 a month making student loan payments again. Now, in my opinion, guys, I think we're going to see another increase in the federal funds rate in July. I think once the numbers start coming in here in the next couple of weeks, the Fed is going to have a chance to begin to see that the GDP is falling, but we still have a stubborn core PCE number. And I think that core PCE number is going to weigh heavily on the Fed's decision in July to perhaps increase rates again by 1/4 or 1/2 of a percentage point. 25 or 50 basis points, I think, is what we're going to be looking at in July. So we'll see. For us right now, no rate hike right now this go around. Good news for the stock market, because as you guys know, every time the Fed increases the federal funds rate, the stock market goes down. But no rate hike this time means the stock market may rally. And those that have their money in the market and are needing or wanting to get to their money and see their money grow, the market usually responds well when the Fed does what they did today, which is not raise rates. Now, the Fed Chair Jerome Powell also hinted to and talked about the fact that we could see 2 more increases in the federal funds rate sometime this year, perhaps as early as next month in July. So don't get too excited about the fact that everything looks great, because there's some issues out there and these interest rates could go up again. Guys, I just wanted to give you this information, right, to keep you informed and let you know that there's still a reason to be cautious in terms of the economy moving forward. And just to realize that right now we're at a pause in the increase in the federal funds rate. Hasn't stopped. Guys, drop me some comments below and let me know what you think about the Fed's decision this time around to not increase rates. Do you think the Fed will increase rates again in July? Let me know that in the comments below, guys. And stay tuned to this channel for more information on the U.S. economy in plain language. Smash that like button for me, guys, and please consider subscribing to this channel if you're not already a subscriber. Again, stay tuned to this channel, guys, and we'll catch you on the next video. Peace.